I feel like I'm living in some dream world that I just can't wake up from. And I really want to talk about the interest rate recovery plays that I got horribly, horribly wrong when it comes to some of these dividend ETFs like SCHD. And we can see a one-to-one comparable, especially with Canadian dividend ETFs on the back of aggressive interest rate cuts. But the first thing I want to point out is this dream world that I'm living in where I am not an economist. I am just some influencer clown on the internet. And I Google around, as many of you do as well. And when I see the President of the United States saying interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Let's rock and roll America. Yet, when you Google or talk to any economist since the Great Depression, for that matter, tariffs are inflationary, raising consumer prices for Americans on oil, electricity, automobiles, groceries, and much else. Besides, inflation will require American interest rates to remain constant or even rise, making it more attractive to hold American assets, especially Treasury debt. It doesn't matter what you Google around, there's nothing that the United States president says that I can fully make sense of other than perhaps negotiating tactics to take over other territories. And some of you have called me out saying, hey, I made a joke yesterday. I said, you wouldn't mind being the 51st state if culturally they fix some things up. And you guys pointed out that you wouldn't mind being the 51st state. I like your videos, but I feel like that isn't something you should say. So please allow me to clarify, as I love American capitalism. I love the US dollar. I do not love America culturally. And this isn't a hard thing to figure out, right? Like, Canada has healthcare at any income bracket. Our education in Canada ranks top 5 always. The US is like bottom 40. Gun control. Our kids don't have to go to school and learn how to use backpacks as armor. Life expectancy is substantially higher in Canada. Drug rights and drug control much better in Canada. Abortion rights, we figured that out. Gay rights, you name it. Our RSPs and TFSAs are far superior to your Roth IRAs and 401ks, and that's just to name a few things. But the divisiveness of hoping we can come to some terms as partnered countries would be much more superior than the US just trying to take over Greenland, all these other countries that clearly don't agree with American culture to the same extent. And I'm very thankful that I can sit here with all my Canadian rights and invest in US capitalism tax-free through my tax advantage accounts and use that capital as I see fit. And speaking of that capital and looking at the US markets that are trading at really ridiculous highs on valuations on the back of a president that makes no sense, that actually looks like he's going to cause more issues for the economy than he's going to fix in the short term. You're talking about companies trading at wicked high valuations here that have actually started to lower guidance on quite a few earnings. And on top of that, we're talking about AI companies trading at multiples that were never even seen in the dot-com era. I mean, you look at a company like Cisco that was trading at 190 PE at its peak during 2000 and basically was growing at a 50% clip, which do that comparable to what's going on with Palantir right now. And the numbers just get more and more absurd, especially when you look at Tesla and so many of these other companies, right? So I need a correction. Like, for me to be mentally healthy in a market environment like this, where it's all just pure fugazi at this point, I need a drop. I need something to justify what is going on here, because I'm not buying these stocks in relative comfort, to say the least, right? And we're seeing the same kind of peaks happening here in the TSX, the Shanghai, the NASDAQ. None of these things are materially growing at this point, right? So what I'm looking at is kind of an overvalued market. I've been incredibly wrong about the interest rate cuts, and it looks like we're not going to be getting those anytime soon. CPI for all items rose 0.5% in January, which is substantially high. It's putting inflation back toward the 3%. We're not on the continued downward trend. This means interest rates are going to stay higher, which is better for some inflationary pressures in the United States, which I'll get to in a moment. I know this is convoluted. I know it's really complicated, but let me refine, dine, and simplify with first and foremost, a lot of items were materially higher. I mean, food came in much higher. I mean, energy came in substantially higher. And now that Trump's tariffing steel and aluminum, likely going to get back involved in tariffing the auto industry, it's likely that a lot of things are going to continue to move higher in that aspect, but we should see some cooling effect in February on the back of basically cooler oil prices, because I think oil is a determining factor to what happens with inflation, because it affects everything. And it was materially higher through the month of January, but now it's cooled off into February. So that should take some of those alleviating pressures. But CPI inflation is too hot even before Trump's tariffs. So I'm really intrigued to see how long interest rates are going to stay high for, because it really affects a lot of people on housing and many other things. But if interest rates dropped enough, it would spur spree spending again, which would continue to inflate prices. It just doesn't matter where I look. It's all negative. There's nothing positive coming out of any of this news. So what I want to zoom in on here is talk about, do I still believe in SCHD and VDY are kind of interest rate recovery plays? Because VDY has been doing substantially better because Canada has been cutting rates on much lower inflation. We can make more sense of it here in Canada. So we've seen a material impact on interest rate sensitive stocks, which are mostly dividend stocks because they have higher debt to equity ratios, usually or debt to asset ratios, because a lot of these dividend companies are usually infrastructure oriented, but all companies can be affected by higher rates, but specifically dividend stocks, right? So if you look at SCHD, when we found out that they weren't going to cut rates like people anticipated, the stock tanked miserably. To me, this is a clear sign that once we do get past this inflationary cycle, that these stocks will likely perform well. And right now it opens up somewhat of a buying opportunity, in my humble opinion, because most dividend stocks, with the exception of maybe some financials and a few others, but a lot of stocks that I look at the Schwab dividend ETF, whether it be Verizon, Pfizer, a lot of good companies in here, Home Depot, are largely affected by those interest rates. So I still think, and I'm still very confident to hold on to this and collect a nice yield that I can reinvest or take that dividend and put it elsewhere. But I'm going to hold on to this. I don't plan on letting it go. And the other concern that I have here right now too is what happens, and one thing I can't really work my head around is if they do materially start to cut rates in the United States, what happens to money market funds with global currencies flooding into US dollars and US treasuries and US money market assets? Will that money actually start to materially come out? And what does it mean for the US dollar? Because the US dollar loves higher interest rates. In fact, when inflation goes higher, the US dollar goes higher, which means you as a US citizen have much superior global purchasing power. And I will state this again, if I lived in the United States and I was purely making US dollars, I would severely look at purchasing global assets. I know a lot of people don't like China. I've been looking at China recently because they're looking to be on the rebound here. Looking at Canada, there's a lot of great Canadian companies that still have great growth behind them. And you are literally able to buy these stocks at 30, 40 cents on the dollar. Like the discount you are able to achieve with the overinflated US market, it'd be good to look at it as a way of diversifying, unless you're already buying something like VT or XEQT, like getting some global diversification as it is. But I notice a lot of US investors seem to hyperfixate on purely US stocks, but as a globalized investor that mostly fixates on US stocks, I recognize there are buying opportunities beyond the United States today. Now, outside of that, you can take a look at the Canadian dollar, and yes, it dropped as the US dollar rallied, hand in hand here. So the US dollar will remain strong for as long as interest rates stay strong. But again, if you cut interest rates, the US dollar goes down, that kind of impacts global purchasing power, which could further inflate inflation. It's a dream world that it's so fugazi. I can't figure out what's going on anymore, and it scares the living crap out of me. So that's where we kind of sit in this market environment where nobody knows if we're coming or going. And honestly, as an economist or an analyst right now, I don't know how you're not on the floor having a seizure over what is happening here, because it's so it's just not sensible. Nothing is sensible anymore. There's no certainty in this market environment, which leads to better uncertainty for the market. So why is the market not crashing? Tell me, please. Why aren't we collapsing? I want to buy better prices.